Hi everyone, my name is Piterpakulski. Today we will continue building financial model for a clothing store or a shoe store. So actually we are building a chain of stores. So we have 40 stores in our chain. And today we will be cooking internal rate of return. We will be calculating this parameter. This will be a very interesting journey. Please like, share, subscribe. You can always order financial models from scratch for your unique business ideas. At the end screen of this video, I will give you the link to the playlist where I will be keeping all these tutorials. And when I completely finish this model, I will give you all the links in the description of this video as well. So you will be able to see the whole process, to watch the whole process from scratch till the final overview absolutely free. So first of all, let's very quickly run through what we did before during our previous tutorials. So in our model we have a core where we are setting up the chain, and we have six portraits of stores. So we can have a small store, medium store, big store, huge store, for example. In our chain, a store which generates losses, and we will close this type of store. So here we're setting up the parameters of revenues and expenses for different types of stores, and then put them inside the chain. So first of all, let's go to one of them. I will quickly show you what inputs we are playing with. So the first rule is all our inputs are colored with specific color. It is blue color, like this. So these are the inputs. This is needed for the future scenario analysis. So we will be playing only with blue cells, generating scenarios, different. So we have, when we are talking about the store, we have, let's assume that we have two collections. Spring-summer collections and, for example, autumn-winter. Here we're setting up when we start selling this collection. Then we specify the product line for this collection, pricing. We can switch on and off items from collections, from revenues, from the cash flow statement. We can have global and local coefficients to increase and decrease pricing. Then we set up the sales plan per season. Then we are setting up global and local coefficients for the sales plan. Then we specify the level of manufacturing costs from pricing. We have global and local coefficients for manufacturing costs. Then we play with this price discounting. So when we start selling this collection, we have no discounts, then they appear, they start growing. We can specify discounts for different product line items. Then we start allocating the sales plan inside the timeline. So here we start selling the collection. This is the season, and for example, we sell 40% of items during the first month, 20% of sales plan goes to the second month, 10% of sales plan go to May, third month, and so on. So here we allocate 100% of the sales plan in this block of inputs. Then we are moving to autumn-winter collection, and here we are doing the same. Product line, pricing, sales plan, discounting, price discounting, sales plan allocation. And we are describing the manufacturing costs. So this is the moment when, just a second. So this is the moment when we start selling our collection. Before this moment, we have 6-month period prior to this moment when we are manufacturing the product line. And here we are allocating, inside this period, we are allocating the 100% of manufacturing costs. This is for spring-summer collection, this is for autumn-winter collection. Here they are. Then our store has some fixed costs. We specify fixed cost here, monthly value, on and off for each item, global and local coefficients. For scenario play, then we are describing payroll, positions, amount of people on each position, salary per person on each position, on and off, global and local coefficients. Then we are talking about investment plans. So here is what we are investing in. This is the moment when the revenue starts. Before this moment, we have 6-month long investment stage, and here we specify how much we are investing in this or that item before the revenues. So here we have on-off bottoms, global and local coefficients for scenario play. Then we are setting up the life cycle for the store. For example, if we have some type of store which generates losses, we will close this store, for example, in 2 years. So here we will be typing 24 months, and all revenues and expenses will disappear after this period of time. So then we are specifying the asset tax monthly value. Then we are setting up the speed with which we are reaching the target revenue. So when we open a store, we are assuming then we will not be reaching the target revenues right from the first month. So we will be achieving these revenues step by step. And here we can specify these percentage values, the steps. Why we need this? Because here, during this period of time, the project may generate losses, and we will need to finance these losses. So this additional financing will be added to total financing on the investment stage, and this will form the overall money needed for the business start. So this is very important block of inputs, because this will show you your possible operating losses. What's next? Then we are setting up the first year of our projections. Here we have global coefficients for all the pricing, all the sales plan, manufacturing costs. We can increase, decrease these costs. Fixed costs, payroll, investment plan. Here we can name the types of stores that we're using in our chain. We can switch them on and off from calculations if we are, for example, too optimistic with some type of store. Then we have a core where we have 40 stores. So we have 40 stores, and for each store we can specify what type of store it will be, when we're gonna open it. We can switch this store on and off from calculations, and this will affect the cash flow statements, simple, discounted payback period, net present value, and so on. Then we are moving to we are modeling the loan. So here we are modeling the loan. So here is the amount of loan. This is the term of loan, interest rate, grace period for interest payments, grace period for principal payments. This is here we set up when we get this loan, year and month. Then we are moving to the management company. For management company, we have three scenarios of adding a management company. The first scenario is when we're adding the management company when we open the first store. This is variant number 1. Then variant number 2, when we are adding the management company when the chain reaches, for example, 15 stores or 12 stores or 5 stores. So we can specify this value. And third variant is we are specifying manually when we would like to set up the first month of operating activity of management company. Then we are choosing what variant we would like to use for management company, and we can switch on and off management company as well to see how the chain itself performs without management company. Then we have management company fixed costs, payroll, investment plan, asset tax. Then we are setting up the tax rates. Then we are building cash flow statement. Then we are calculating the amount of financing needed. Then we are setting up the discount rate and calculate simple payback period, discounted payback period. So these are the diagrams, and we are putting them on the top here. So if we would like to, for example, play with increase the amount of the amount of investment plan, we can do it here. See how the diagram of the chain will change. So now let's create the internal rate of return value. So what we need to do, first of all, I would just create a new tab for internal rate of return. So what I will do, first of all, I will put discount rate a little bit closer. I will copy these values, put it here. Then this value, this cell will no longer be the input. I will pull this. I will be pulling this discount rate from there. Then I will put here net present value. So net present value I will be pulling from discounted payback period diagram. Here it is. So this is net present value. Then this will be internal rate of return. This will be a percentage value. Then this will be the step of discounting. So I will be discounting our cash flow with the step of 1%. So this will be the input. Then I will start. So here I will put discount rates. So the first rate will be, I will be setting up the first rate, discount rate that I will be starting with. Then I will be adding this starting rate plus the step. Let's assume that I will be looking at 1000 rates. So here I will put net present value, and then I will select this table so here I'm selecting this table. Then I'm going to data, what if analysis, data table, and here I will put the discount rate. Now I will press enter and magic will happen. So for zero discounting, I have this net income. So this is net income with zero discounting. And then we can see when the project reaches 78, the discount rate with the value of 78, we have negative net present value. So this is an internal rate of return. So now we need to find this moment and place this value on the top and place this value here. So what I will do now, so if this value is less than 0, I will put 1, otherwise 0. Okay, then if and this equals to 1, we will put 1. Just a second. Then if and this value equals to 0 and this value is more than 0, we will put 0, otherwise if this one equals to 0 and this is less than 0, we will put 1, otherwise 1. Let's close these brackets, and now let's extrapolate this formula to the bottom. Now we can see how this one appears here. Now let's extrapolate this formula to the bottom. Okay. Now let's find the rate. So if this one equals to 1, we will put this discount rate, otherwise 0. So if this value equals to 0 and this equals to 1, then we will put the discount rate, otherwise 0. Closing brackets, extrapolating the formula. Now we see here the discount rate. Now let's create a total for this line, for this column. So we can, for example, adjust the step, for example, 0.2%. So this is the internal rate of return, and now we can consolidate our financial efficiency, and this will be the next topic of our video. So please guys, like, share, subscribe. You can always order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the link to the playlist where I will be keeping all these tutorials, and when I completely finish this model I will place all the links in the description of this video as well, so you will be able to watch all these tutorials absolutely free, one by one, inside this playlist. So for example, if we want to play with, for example, increase the amount of investment, we can go here, increase. We can see how internal rate of return decreased. We can, for example, increase the investment 3 times. So we can see how this value is changing. So now everything is ready for scenario play. So thank you guys for watching. See you next videos. Thank you and bye.